Peace and love, family. Welcome to another Truth to Power Talk with your sister, Dr. Maat. Thank you for joining another powerful discussion. And I have with me tonight another powerful guest, Mr. Moseley. How are you doing tonight, brother?
I'm good. I'm good, Dr. Maat. Thank you for having me here. It's a pleasure, and I'm really excited. All is well.
Yeah, I'm excited to have you. You tonight, family, we're going to be talking about the stock market, and your sister's trying to get in it. And so I reached out to Mr. Moseley a few days ago to talk to him about my stock options. And so I reached out to him, and he provided me with some really good information. And so I asked him, I said, well, Mr. Moseley, would you mind coming on my platform to share this information with my audience? And so he agreed to come on so we could spread this information. And so before we get started, family, I'm going to read his bio to you. So bear with me for a quick moment. Mr. Moseley has over 8 years of investment experience, where he currently serves as a sales channel marketer for one of the top financial firms in its industry within its broker deal division. Prior to his current position, he served as a global investment reporting specialist. And prior to that, he served as a trader within their trading department, where he utilized a variety of valuation methods and systems to analyze securities. Parrish currently holds the FINRA. What does that acronym stand for, Mr. Moseley?
FINRA.
Oh, FINRA. So, okay. So it's not an acronym. Yeah. It's just, okay. All right. So it holds the FINRA Series 7 property and casualty license, and an undergrad degree in corporate financing from Morgan State University. And family, you know, that's where I currently teach and where I've gotten all of my degrees from, Morgan State University. He has also studied at John Hopkins University, Curry Business School for Investment and Security. So thank you so much again, Mr. Moseley, for coming on the platform. I see that, family. I see you coming in right now. Peace to you, brother T. Peace to you, brother OG Gorilla. Peace to you, Fundu. So family, please share this video. Let's get the likes up, man. Let's get the likes up. Let's get the views up. This brother's going to drop a lot of information tonight, and we got to get this out, family, because remember when I brought Mr. Kenneth Kelly on and also Dr. Julianne Marvel on, we talked about creating economically stable families. And that really should be, one of the highest priorities on our agenda, is to create economically stable families. Now, when I brought Mr. Kenneth Clark on, he talked about building economically stable families by opening up checking accounts, savings accounts. He also talked about creating and maintaining a high credit score. And he also talked about investing in life insurance policies. And so towards the end of that discussion, I asked him, I said, what about stocks? And he said, he said, you could bring me back to talk about it. But he said, we want to crawl before we walk, And so anyway, family, so, I had that conversation with him. So I'm bringing Mr. Moseley on to now talk to you all about the stock market. All right. So, Mr. Moseley, let's get started. Let's get started. Yeah. So can you talk to them? First of all, what is a stock? We hear people say stock, shares. Yeah. Can you define that for us? The stock market and what is a share? Let's first start off with defining those terms.
Yeah. So first and foremost, again, thank you for having me on your platform and sharing this information with your viewers. A stock is nothing more but a piece of financial instrument that allows individuals to own a part of a company. For an example, Dr. Maat, if you are CEO of a company and essentially you want to raise capital, what you'll do is pretty much disseminate shares of your company to shareholders, such as myself. So if I purchase or own one of the shares of your company, then in essence, I own a small fraction of your company. So essentially, it gives people the opportunity to own a fraction of the company. That's what a stock is.
Okay. And so a stock market then would be what, Mr. Moseley?
Yeah, so the stock market is pretty much what houses or what kind of facilitate the buying and selling of certain instruments. You have consumers, you have buyers and sellers that sell in the open market and so forth. So that pretty much suits as a platform, if you will, for those individuals to facilitate transactions. So again, it's like a supermarket. Like a supermarket. You go in, you buy your groceries and so forth. The supermarket is pretty much just the house for people such as you and I to go in and buy that product. In this case, it would be a stock or other commodities.
Okay, so when people talk about Wall Street, this is where all of it goes down. Like, so Wall Street, explain that. So when you talk about Wall Street, this is where the stock market is, or what?
Yeah. So again, Wall Street is pretty much a street in New York called Wall Street, and it's essentially the mecca of the investment industry, if you will. This is where a lot of trading go down. This is where a lot of the hedge fund managers are. This is pretty much where a lot of the decision making take place in terms of the economy. And again, this is where it all goes down. This is where equity is traded and all sorts of commodities and financial instruments, from stocks, bonds, mutual funds, you name it. So Wall Street in itself is just the location or a place where these transactions take place. It's pretty much the mecca, if you will.
So the mecca of the stock market. Okay. All right. Well, thank you so much for that. I just wanted to make sure we just kind of, I'm an educator, so I like to start off with like defining everything. So thank you for that. Now, when you and I were talking on the telephone, you did tell me you recommended some stocks that I should invest in. And so you mentioned, I remember the first thing you asked me, you said, well, do you want to hold on to this for the long haul? Are you doing long-term investing or short-term investing? So can you talk about that, and then also talk about day trading?
Yeah, absolutely. So personally, I consider myself as a conservative investor, right? So me personally, I don't really delve into the get rich, trying to, flip stock really quick and make a boatload of money. Like you, essentially, I feel like I'm an educator as well. So my mentality is that I want people to really, conceptualize, understand what this is about, but also hold on to stock for the long term. And in doing so, it's important to understand what you invested in. I think when you and I spoke, I brought up ExxonMobil for an example, right?
Yes, you did.
I brought up ExxonMobil. And I brought up ExxonMobil because ExxonMobil is what you would call a blue chip company, right? So for those who don't know what a blue chip is, in the game of poker, the blue chip is essentially the chip of the highest value, right? You have all sorts of colors, but the blue chip is the chip with the highest value. So in essence, when you hear blue chip stock or blue chip companies, those companies' valuations are relatively high. Their finances are strong. Fundamentals are strong. Fundamentals meaning their balance sheets, their income statement, cash flow statements. They have a lot of cash, essentially, right? Mm-hmm. So these are also companies that have been in the industry for 10 plus years. Moreover, it also gives you an idea of how defensive they are in any economic condition that we're in, right? So you have a recovery, you have a peak, you have a recession, and then you have a drop. So these are pretty much the ebbs and flows of the economy. And with these blue chip companies, they typically are able to weather that storm, right? So these are what you would call defensive stock, right? A more cyclical company would be, let's say, Home Depot. All right. Cyclical meaning that they actually move with the economy. So if we're in a recession, just to kind of put it into perspective, if we're in a recession, you're not going to go out and buy a hammer, but you're going to buy gas, So, in whatever state of the economy you're in, whether it's a recession, whether it's a peak, you're going to need gas, right? Gas could be 50 cents or gas can be, $10 a gallon. You're going to be mad at $10, but you're going to buy it. So that kind of gives you an idea as to why these companies are why they're able to sustain themselves in any economic state that we're in, right? Mm-hmm. And there are also other blue chip companies out there as well. Procter & Gamble, I think, is another company you and I talked about.
Yes.
Yeah, Procter & Gamble, again, is another blue chip company as well. Very strong finances, very strong books. But again, when we think about the psychology behind it, you know, people say, why should I invest in these particular companies, right? Everyone buys toilet paper. You know, Procter & Gamble kind of deals with the household products. And as you know, in COVID-19, you couldn't find toilet paper anywhere, you know? So, and during COVID-19, keep in mind that the market actually bottomed out. So despite the pitfalls that the market was in, people were still buying household products, you know? So if we just look at it on that scale, it kind of gives you an idea of why these companies do so well in certain times of the economic cycle. All right.
Mm-hmm.
I think we also touched on dividends as well. I think that was something you also brought top of mind. I don't, and let me know if I'm moving, ahead.
Yeah, just a little bit. So you were saying long term. So remember, my question was long term and short term. You know, and you said I'm a conservative. So you were explaining like long term investment versus short term investment. So let's talk about short term investing.
Yeah. So short term investing is any investment that is less than 12 months, right? So if it's greater than 12 months, then that's long term. If it's shorter than 12 months, then that's short term investing, right? So in that position, you're pretty much trying to, you know, get in and get out, get a quick, you know, quick return and get out of the market, right? The only issue, well, I wouldn't say issue, but with that, you have to be very acute in terms of what you are investing in. All right, meaning that if you're like, hey man, what stock is out there that I can get in and make some pretty good money in? And it's like there's a boatload of stock out there, but you have to do your due diligence. You have to really peel back the layers and understand how profitable the company is going to be. You know, are there any, you know, mergers or acquisitions that are underway? You know, because a lot of times when you see companies on the surface level, it doesn't give you the whole totality of what's going on behind the scenes. So to answer your question, short term, you know, those are some things you should keep in mind for those who are interested in short-term investing, to just be very aware of what you're investing in and do your due diligence. You know, use resources like Yahoo Finance and, you know, look at the income statements and look at the, you know, the balance sheets of the companies, the CEOs, you know, see who else they're partnered with before you decide to get into the company. And that's short term or long term, but specifically short term, I feel like you have to be a little bit more thorough in your research, because you can lose a lot of money.
Okay. And what about, speaking of the documents or the financials that you should, I guess, examine prior to investing in a company? My son Isaiah was telling me about 10Ks, and he said that each year companies are required to release a document called a 10K. Are you familiar with that document, Mr. Moseley?
Yes, I haven't seen a 10K in a while. I believe the 10K is more of a document that outlines a company's earnings or something of that nature, you know, kind of give you an outlayer of, you know, what the company has done for that year, you know, along with like the proxy and so forth. But I have to circle back on that. I haven't looked at that in a while. So but that's definitely a good source to reference. But fundamentally, you know, as far as the documents, again, the income statement, the balance sheets, anything that has to do with the hardcore day-to-day financing of the company, how they operate, you know, those are some of the things that that I think will be very fruitful for any investor to look into before getting into a company.
Okay, definitely. And just to rehash, you said with long-term investing, you would want to purchase stock in a company that sells things that are necessary, you know, things that are needed, like you said, toilet paper, gas, things of that nature. And you said you also want to make sure that these are blue chip companies.
Blue chip companies.
Absolutely. Okay, and you referred to like toilet paper and gas and stuff like that. You said that's called defensive stock, right?
Yep. Defensive stock. So you have defensive stock and you have stock that are cyclical. As I mentioned, these stock pretty much move with the economy, whereas defensive stock, they're able to hold their own.
Got
Right.
you.
So whatever state of the economy you're in, these companies are going to hold their own. And a lot of that has to do with the product that they sell and the type of cash that they have on hand. Meaning that they may have, I'm just going to use arbitrary numbers. If you have $50,000 in debt and in liabilities, but you have $10 million in cash, you're pretty much in a good space. You can pretty much, how can I put this? You're solvent for the most part, right? So in other words, you have enough cash to meet your long-term obligations. So if you are in a tight spot, or if the economy does tank, you have enough cash to kind of sustain yourself. And I usually tell people, just look at it like yourself, your own household. You kind of keep a tab on your expenses and what you're bringing in, how much savings you have in how much reserve you currently have. And if you have a small portion of debt, but a substantial amount of reserves, I think they usually say you should have 6 months of your expenses saved up or something like that. You're in a good space. So if you kind of just think of that concept and how strong corporations operate, then it kind of gives you an idea of how strong a company is and how solvent they are long term.
Absolutely. So let's move into day trading. Can you explain that? Like, what is day trading? I hear that a lot also. Day trading.
Day trading is, again, short-term investing. That's, again, you want to get in and get out. With day trading, you have to have a certain level of what they call technical and quantitative analysis. So what does that mean, right? So that pretty much means that you're looking at a stock and you're using instruments like Fibonacci's and resistance lines and tickers and candlesticks. So these are strategies that day traders use to kind of back test and pretty much give them a higher probability of making profit in the future. All right. So with day trading, it's very short term. Sometimes they have increments of, think like 5-minute trades, 15-minute trades.
Oh, brother Parrish is breaking up, or is it me? I hope he isn't. I think it's him, family. Hold tight. Let me get him back on. I think he's or is it my computer? Family, tell me in the chat room, can you hear me loud and clear, or is brother Moseley frozen? Because he's frozen on my end. So can you please indicate in the chat room, can you hear me, or is he the one that is frozen, family? Oh, there you go. You're back. Yeah, you're back. Oh, they say you were frozen.
I'm good. Okay.
Yeah. You went out for a second, so I was asking folks in the chat room. I said, "Let me know. Is it me? Is it my computer?" And so you were going out. So you were explaining day trading, and you said that's more of a short term. Yeah, you were saying a short term, but it requires, you said, a great skill. So what was it? Can you go ahead and recap that or rehash that for us?
Yeah, absolutely. So very, very short term. The skill I would say that one should be privy to is just understanding quantitative and qualitative analysis. So again, you're using things like candlesticks, Fibonacci's, resistant and support lines, just to kind of back test certain investment strategies only to predict future return. So, and it's probably a lot of jargon right now, but basically, people, they use this skill set to increase their probability of profiting, right, for a short period of time. So they use these strategies to put in place to ensure to say, hey, I'm going to study the past performance of a stock, based off of these strategies, so that I can make a prediction either when to get in or when to get out of a trade. So that's day trading. The day trading requires a lot of attention, a lot of attention. So unlike long-term trades or long-term investing, what you and I talked about, these are what I would call, you can sleep good at night. You know, you kind of put your money in, you have an understanding of what the company is doing, what they're about, and you're good to go. Whereas day trading requires a little bit more attention, a little bit more, focus and understanding of what's going on in the market, what buyers and sellers are doing, so you'll know when to get in or when to get out.
All right, so family, please share this video. We're talking about financial. We're talking about investments. And these are conversations that we typically don't have in the community. I mean, when I was growing up as a little girl, Mr. Moseley, no one talked to me about the stock market.
Yes.
I mean, I remember my father, when I became a teenager, he encouraged me to open up a bank account. And when I was 17, my mother took me to, oh my gosh, before it was called Bank of America, it was called Nations Bank. Yes. So she took me to. Am I showing my age, Mr. Moseley? Look, just a little bit, just a little bit. But look, so in the 90s, she took me to Nations Bank to open up. I had to open up a savings account initially, and then when I turned 18, I was able to open up, a checking account. And so that was as far as my financial education went. Okay, open up a checking account, open up a savings account. And when I got to Morgan State University, Discover Card, they were on campus. And they were giving us, we just had to fill out like this little application, and they were giving college students a $1,500 Discover Card. And so at the time, I didn't know anything about, someone's handing me someone's handing me a $1,500 credit card. So what do? I did what most kids do. I was 18. I went out, I took the card, and my cousin and I, we were down. Yeah, we swiping. We're down at Legal Seafood. And look, then I messed up my credit score. My credit score went down because I wasn't paying on time. And then that's when I started learning about credit scores. And so these are conversations that we need to be having with our children. We need to talk to them about checking accounts, savings accounts, credit scores, the stock market, just investing, life insurance policy. See, these are the conversations that we need to have. A while ago, someone asked me, Dr. Maat, what do you think the highest priority on the Black agenda should be? And I said to that person, building strong families should be our highest priority. And so in building strong families, we have to make sure that our families are economically stable. And so how do you do? Financial literacy. We have to teach it. We have to teach it, and so anyway, brother, family, please share this show. We're talking about the stock market. We're talking about investing. Please share this show. Let's get the information out there. If you haven't thumbed up my video, please be sure to thumb up the video. If you're on Facebook watching the show, head on over to YouTube, subscribe to my channel, hit the notification bell so that as soon as I go live, you will be notified. So let's go ahead and continue, Mr. Moseley. Let's get into mutual funds.
All right, mutual funds.
Yeah,
I love mutual funds. I love mutual funds. So unlike stock, mutual fund is pretty much a pie, right? This is how I would describe a mutual fund to someone, right? You ever heard of the old term, you don't want to put all your eggs in one basket, right? So when you buy one stock, you're pretty much putting all your eggs in that one basket, right? Whereas a mutual fund, if you think of a pie, you think of a pie that has multiple slices, right? Each slice represents a different company, right? From different industries. You could have one slice that's, consumer good. You can have one slice that's, electronic. You can have one slice that's, a conglomerate and so forth. Now, what does this mean? It typically means that you're diversified. Your eggs aren't in one basket. So how is that advantageous for an investor? Well, because you are diversified and you're pretty much in all these, slices, if you will, if one particular sector does bad, let's say healthcare, right? Let's say out of the slices, healthcare is one of the slices in your pie, and they do bad, your portfolio, your mutual fund isn't going to take much of a hit because the other sectors are performing quite well. So it kind of builds a cushion of security, if you will, versus investing in just one stock. All right. So there is a level of diversification, and pretty much diversification meaning that, you know, you're I want to say diversified, but you're mitigating the risk, I should say, mitigating the risk of possibly losing all of your money or just taking a substantial hit. So mutual funds kind of give you that cushion to ensure that, I'm not going to say that your return is guaranteed, but you can pretty much weather the storm relative to just having one particular stock or your eggs in one basket.
Okay.
You know?
Well, I appreciate that. So let me ask you a question. I remember when we were over a mutual friend's house, brother Andre, and we were talking about 401ks, and he called it a glorified savings account, and he called it a glorified savings account. And then it was another brother, I forgot his name. He was I think like a manager at a bank, but he was even saying that it doesn't make sense to have $40,000 just sitting in a bank account. You know, he was saying like make your money work for you. So yes, it's good. It's good to have a savings, but while you had the savings, take some of your money and put that into, you know, I don't know, real estate, stocks, something else. So what are your thoughts on that?
I mean, I think it's a very solid outlier, because you got to think about the inflation increased by 3% every year, right? So if your money is sitting in, you know, a checking account or a savings account, I mean, you're already losing, because in a savings or a checking account, they don't even give you 1% of, they don't even give you 1% of the money that's in there, probably less than 1%, right? So with that, yes, I do agree that you should not have all your money in a savings account. But yeah, you mentioned 401ks is a really good instrument to have for those out there who work for government entities. I think it's a not a 529. Oh man, I'm drawing a blank here. It's a government. It's pretty much a retirement account for government workers. Corporate entities have 401ks, but the beauty about the 401k is that most of the time companies actually match you, right? Mm-hmm. So that's free money that you are potentially missing out on by not having your money in a 401k. And oftentimes what'll happen is companies, they would allocate your funds for you within your 401k and those mutual funds you and I talked about, right? Mm-hmm. So you not only have that level of diversification with the 401k, but you also have the matching capabilities as well. Now, what does that mean? That means that, hey, if I put in $1, some companies would say, we'll put in $2. You know, you're not getting that in the savings account. And there are an array of, advantages of having a 401k. Like I remember years ago, when I started at the firm, I actually was a retirement specialist, right? So, you know, I would inform people that that their 401k had a number of options where they could borrow against their 401k to purchase your new home. Now, we don't suggest you take money out of your 401k, but you know that option is still there as well. And you're not taxed on it. You know, it's pretty much tax deferred. Now, what does that mean? That means that, you know, the money that you take out, you're pretty much paying yourself back, right? So if you borrow from your 401k, let's say $10,000, sometimes the plan is set up where, you can take maybe 50 or $100 out of your paycheck to pay down that 10 grand that you took out, and you're not taxed on it. You know, so these are some things people don't even know. People, you know, they're thinking, oh, I just got to save up to purchase a home. But a 401k sometimes will provide you with that leverage or that opportunity for you to put down on a new home, you know. And they have hardships. Some plans have hardships, meaning that, you know, you have people out there who can't pay their rent. You know, they're behind on their rent or their mortgage. You know, some plans have provisions in place where you could, reach out, you can fill out a form and pretty much ask how much you need with proper documentation. So if your bank says you're 2 months behind on your mortgage, you can actually get that document from your financial institution, bring it to your employer, your 401k, and say, hey, look, I'm behind, I need this X amount of money out so I can pay towards my mortgage, and you can utilize it as such. So, these are some things that people are missing out on by not investing in your 401k.
Okay, so 401k is a good move, but like you said, we shouldn't just keep our money like in a savings account. It needs to be somewhere working for us, basically.
Absolutely.
Okay. All right. So look, going back into the stock market, I remember when you and I were talking, you said, well, I typically like to invest in or purchase shares, in a company that pays dividends. So let's talk about that.
Yeah.
Let's talk about dividends.
Yeah. So dividends are pretty much monies or earnings that the company pay you as a shareholder based off of the profitability of the company, right? So let's say, Dr. Maat, you're the CEO of a company, and you had a strong quarter. It was good. You're excited, right? And I'm a shareholder, and you say, hey, look, Mr. Moseley, the company did good. Our earnings are up. We want to bless you with the dividend. Really? Absolutely. We want to bless you with the dividend. We want to give you money because we're profitable and because you are a shareholder. You are a shareholder in my company. So essentially, firms or companies, they pay their shareholders dividends, oftentimes on a quarterly basis. A perfect example of this would be ExxonMobil. As what you and I discussed, ExxonMobil pay a quarterly dividend, right? And the dividends is contingent upon how many shares you have. For an example, if you have, 4 shares, it'll be that dividend times the number of shares that you have. All right. So again, if you have, if the dividend is 90, let's say, I don't know, 90 cents or something like that, and you have 4 shares, that's $3.06, just for number's sake, right? And companies ExxonMobil, they pay that every quarter. So that's 4 times a year. So again, we talk about growth, right? So this is another way that, people who are in the market can make money off of the dividends, off of the monies that firms or company pay them just for being shareholders, right? So the next question could be, okay, I get the dividend. What do I do with it? Do I ball out of control or something like that? Do I make it rain? No, you don't do any of that. You want to reinvest those dividends, reinvest your dividends. So basically what that means is, Dr. Maat, again, you being the CEO, you pay all your shareholders a dividend. And what I say is, you know what? Thank you. But what I want to do, I want to put it back into the company, or I want to put it back into my portfolio. I'm not going to spend it. I don't want you to disperse it. I want to reinvest it. And that's how you get the compound, and that's how your portfolio grow, right? So yeah, I like companies that pay dividends. That's my philosophy. If it don't pay me money, I don't want to invest in it,
Okay. Yeah, I like that philosophy. But so I like that philosophy. So now I want you to explain stock splits for me. You and I were on a telephone, and we were talking about stock splits, because I know you said at one point Exxon got up to maybe $80 per share. And then you said that it went down to 40. So you said, I don't know, it could have been a stock split. So could you explain that to the audience?
Absolutely. So stock splits occur for a number of reasons, right? Oftentimes, companies like ExxonMobil, they pretty much have a price that averages out, anywhere between 85 to 95. I'll say $85 to $90 a share, right? So if you and I are invested in ExxonMobil, we're kind of used to that, right? We're kind of used to that particular price. But if the company's price get to a certain point where it's no longer favorable, then we're not going to buy it because it's too expensive, right? It's almost like when you talked about Amazon. Like, I like Amazon, but I don't want to pay $2,000 for one stock,
Yeah, well, Amazon is up to $3,100.
Exactly, it's higher than that. But the case point is that normally companies like that, they're priced at a certain point so that it's affordable for their shareholders. But once it steps out of that threshold, it's no longer favorable. It's too expensive. We can't buy it. So what CEOs do is that they do stock splits. What is a stock split? Stock split means that the price of the price of the stock divides itself by half, but the number of shares double. For an example, let's say if the stock was trading at $40 a share, right? And let's say you had 100 shares, okay? That means the value of that portfolio is $4,000. All right. So if you write that down, if you say $40 times 100, that's $4,000. All right. Now, the CEO said, okay, you know what? $40 is a little too high for our shareholders. So let's do a stock split. So what happens is that it'll then be $20, right? It'll have the price will divide by 2 times 200. All right. But the value stays the same. All right. So people are maybe wondering, okay, I get it. You know, it was at $40. You know, I had 100 shares. Now it's $4,000. The stock split is at, you know, it went down to 20. Now I have more shares, but the value's the same. How am I making money in this equation, Nate? How am I making money right now? Well, what happens is after the split, the price will eventually go back up to its normal price of $40. So now, again, after the split, you have 200 shares, right? You have 200 shares, and let's say it go back up to $40. All right, so now we do 40 times 200. Now you have what? You have $8,000. All right, so that's a stock split. That's what occurs that's what happens when a stock split occurs. All right. So, and also the psychology behind it, as I mentioned, is that the price becomes too expensive for the shareholders in that industry. You know, people aren't buying it anymore. So the CEOs have to make an executive decision to say, okay, we need people to purchase our stock. So let's do a stock split. All right. And another reason why companies do stock splits is to get capital. You know, sometimes CEOs or companies say, okay, we need to raise some money. And their CFO come in and said, hey, Dr. Maat, you know, what are your thoughts? And you say, I don't know. What do you think I should do? Well, you can issue bonds. Nah, I don't want to issue any bonds. You can dilute more shares. Nah, I don't want to dilute more shares. Let's do stock splits. So by you doing a stock split, people are going to buy the stock more, you know, because at 40, they weren't buying it. It's too high. But if it's at $20, I can afford it. It's cheaper, you know, so people are more prone to purchase the stock. Does that make sense?
It makes perfect sense. I'm over here thinking about Facebook and how when they initially, I guess, revealed their IPO or, you know, stated their IPO, that's the initial public offering when they first made it. I think it was like $24. And I started, Mr. Moseley, I'm telling you, I'm kicking myself right now because I started to invest in it. And I was like, nah, that's a little social media platform. I'm not getting that. Yeah. And now I'm kicking myself because the share is up to $220 something. Even I believe Netflix, when I was first looking at Netflix back in the day, Netflix was at about $15, maybe 15, 20 bucks. And now, and now a share is worth $481. And so I'm thinking to myself, Doc, what if you would have just grabbed, you know, what if you just would have grabbed, 100 shares, spent the cool $1,500. Look at how much money that would be today. And then I'm also thinking about Amazon. You know, when they first made their IPO, I think, well, no, not the IPO. When I first started looking at it, they were at around 1,700 a few years back. And now they're at 3,100. And so, oh man, I'm just sitting here thinking about, we got it. When we see these opportunities, I guess we have to, because I didn't look at Facebook as, I didn't think it was going to be a big company. I just looked at it like it was just social media. But let me ask you a question. What are your thoughts about Twitter? Because someone told me that I should definitely look at Twitter. They think that Twitter is going to do something. So what are your thoughts about Twitter, Mr. Moseley?
Yeah, well, first and foremost, I would say, do your research. Me personally, I haven't really dialed into Twitter to say, hey, you should go ahead and get it. But one thing I do know for sure is that Twitter, just like any other platform, i.e. Facebook and all of those platforms, they are heavily utilized in our society right now. And if you look at where we are today with this whole COVID-19, that's pretty much our go-to source in terms of communicating, right? So I would urge people, who are interested in Twitter and so forth, to really read some articles on Twitter, find out, who they're partnering with. Are there any mergers and acquisitions behind the scene? And you can find all of this information on platforms like Yahoo Finance or Bloomberg. These are critical information, critical, informative resources you can use to make a more prudent investment decisions outside of just, oh, I'm going to invest in it because somebody told me to.
Right, right.
So I would strongly encourage you all to do your due diligence. Look up, read articles, find out who's behind the scenes in terms of their CEOs, and if there are any CEOs who step down or any board of directors who are stepping down. Because rest assured, these are some of the reasons why stock prices go up and down. These are one of the many reasons why stock prices go up and down, because a lot of the decision makers, either leave or someone come in. So going back to Twitter, just find out who are the decision makers, what kind of decisions are being had, because that can be a good indicator whether you should buy in or not. Because Twitter could very much so be acquiring another company or partnering with another company, that could be, the future of tomorrow or something like that. So these are all good indicators that analysts use to discern whether or not they should get in or out of a company. So that's what I would strongly encourage your viewers and even yourself to do. When somebody come at you with a, hey, you should invest in this.
Oh yeah, absolutely. Oh, you always got to do your due diligence.
Absolutely.
Yeah.
Absolutely.
So Sister Love Me Fro, she said, what about face mask companies? Would this be good to invest in?
That's a really good question. Now, it depends, right? So one thing when we're evaluating stock is we look at what's called the barriers of entry. All right. So what does that mean? That means how profitable or how profitable can a company be with like keeping its competitors at bay? A lot of times if companies are oversaturating the market with one product, then the company really can't be that profitable because everybody's selling the same thing. So the question is, what mass company would set itself apart from the rest? What would allow a company to have a wide economic moat? So for your viewers who don't know what an economic moat is, an economic moat is, a term used to, again, identify how profitable a company is while keeping its competitors at bay. So if the moat is wide, that means that the company is making a lot of money and they can keep their competitors at bay. So going back to the face mask, the question is, what will make a company, a face mask company profitable without, while keeping its company at bay? A couple things. What type of intellectual property do they have? What type of patents do they have? Why is this important? Because if a company has a patent, a competitor can't do the same thing that mask or company mask or mask company is ditching out. That's pretty much their safe hold. If you look at any industry, if a company has intellectual property that's special, that's unique, that consumers like and they flock to, that's what keep their barriers of entry high, right? So going back to the mask deal, those are some things I would look at, because if you notice, everybody's making masks. I actually have a cousin in her basement now who's making masks, and she's doing pretty well, in this time of COVID-19 right now. So what I would look into is like pharmaceutical companies who are coming up with vaccines for COVID-19, not so much the mask, not so much the companies that are making the mask. I would figure out what companies are out there that are involved in the vaccine of the COVID-19. I know I'm kind of just shooting from the hip right now, just thinking about how everything is connected. When you talk about the mask, you talk about COVID-19, so that I'm automatically thinking about like the vaccine, because I know that mask, you know, it can be easily duplicated, basically, you know. So investing in the mask company specifically, I would look at 3M. Right. So 3M is a company that makes masks, but 3M also makes other, you know, medical equipment, you know, that they use in the medical field for surgeries and stuff like that. You know, that's a pretty good company to look into. Obviously do your due diligence, but find out what 3M has got up their sleeves. Find out if 3M is partnering with any of these pharmaceutical companies that we're talking about, while looking into, you know, trying to figure out a vaccine. They could be partnered with them already. So I would definitely look into that company. Even Johnson & Johnson, you know, Johnson & Johnson could be a good company to look into as well. All of these are healthcare, you know, strong healthcare companies. I would suggest looking into. Do your due diligence.
Excellent.
Sorry,
and so,
a little long-winded on that question. Sorry about that.
No. And shout out to Brother Calvin. Right before you said, look at 3M, you know, he said it in the chat room. He said, look at 3M for a mask investment. So thank you so much, Brother Calvin Haynes, for that. So during our conversation, you talked about cost dollar averaging. And so can you explain that to us, please?
Absolutely. So cost dollar averaging is a strategy used to average out the cost that you pay for a stock for a long period of time. All right. So let's break it down. So again, let's say you are invested in ExxonMobil. All right. I know I'm always using ExxonMobil, but let's say you invested in ExxonMobil in January, and you say, you know what? Every month I'm going to put $50 in ExxonMobil, just $50 from January to December, right? So as you know, from January through December, ExxonMobil is going to fluctuate, right? But by you putting $50 in ExxonMobil every month from January to December, you're pretty much averaging out the amount you pay for the stock. So if in February Exxon could go up to 60, you're going to get it. You're going to get it. If it drops down to 45, you're going to get it. If it goes back up to 75, you're going to get it, and so forth. So it's going to fluctuate. So what you're doing with the strategy is that you're averaging out how much you pay for the stock for a long period of time, right? So that's a good strategy. So, you know, if it does go up, you know, people may say, oh man, I missed out on it. It went up. You know, if it go down, it's like, oh man, I lost money. You don't have to worry about that, because you pretty much have your foot in the game. You know, whether it go up or down, you're still going to capture those fluctuations. You're averaging out how much you pay for the stock for a long period of time. So that's the cost dollar average, you know, concept.
All right. Thank you so much, Brother Parrish. And I just want to take time out to recognize the brothers and sisters from the Baltimore Entrepreneurship Facebook page. I know I see a few of them in the building watching. Thank you so much, brothers and sisters, for joining us. We're talking about the stock market and using the stock market as a means of creating wealth. So I'm on YouTube, family. So look, going over to YouTube, subscribe to Dr.maat.msu's YouTube page. Click subscribe, click the notification bell so that anytime that I go live, you will be notified. So thank you so much, brother, Mr. Moseley, for explaining cost dollar averaging. Lastly, when you and I spoke on the telephone, we talked about ETFs. So can you explain to the people, what an ETF is?
All right. So ETF stands for Exchange Trade Fund, Exchange Traded Fund. So basically, I know earlier we talked about a mutual fund. We talked about the differences between a mutual fund and a stock, right? Right. An ETF is essentially a mutual fund that trades like a stock. So what does that mean? Doesn't mutual funds trade like a stock? Not necessarily, because a stock you can actually trade throughout the day. All right. So what does that mean? That means you can trade a stock at 12. You can trade a stock at 1 o'clock, at 2 o'clock. You can trade it throughout the day. All right. But a mutual fund, you can't. You can't trade a mutual fund throughout the day. You know, mutual funds have what they call forward pricing, which means that if you wake up at 12 o'clock and you want to buy that mutual fund, you will have to purchase the mutual fund's net asset value, which is calculated at the end of the day. All right. So if you wake up at 12 o'clock and you see a mutual fund you want, you know, you're not going to buy it at the price that you see at 12. You're going to buy it at the price that's calculated at the end of the day. So how does this relate to an ETF? Well, an ETF, you can treat it like a stock, meaning that if you wake up at 12 o'clock, you see the ETF, you can buy it right then and there. All right. So how it's like a mutual fund is that it has that diversification component like a mutual fund, right? So again, you don't want to put all your eggs in one basket. All right. So mutual funds comprised of, you know, different sectors, different companies, and so forth, and that you can buy them intraday. So that's the main differences between the mutual fund and the ETF, i.e. exchange traded funds, right? And it provides you with the level of diversification, more exposure to the market, more cushion against volatility and so forth.
Absolutely. Thank you so much for that. And I know that time is winding down right now. I see that brother Jeremiah Africa made a comment in he posted a comment. He said, our people need a collective team of brothers and sisters that know and understand this with precision like him. Brother Jeremiah, I couldn't agree with you more. Can you imagine how much wealth, you know, we could accumulate if we had teams of brothers and sisters, you know, doing this, you know, with this knowledge, spreading the knowledge, and we're working in team, just, yes, I mean, come on, yes, man, we could really, yes, make some money. But I know time is winding down, Mr. Moseley, and thank you so much for answering all of my questions. But what do you say? What recommendations for stocks do you have for someone that says, look, you know, I want to get into the stock market, but I don't know where to start. You know, how can I jump into this? Should I jump into cryptocurrency? I know that's what Dr. Boyce Watkins pushes a lot, the cryptocurrency. Yeah. So someone doesn't know what to do, and they say, look, I want to purchase a stock, but I don't know how to start. What would you say to that person?
Well, for first come always, you know, Warren Buffett always say, invest in what you know. All right. So it's important to really invest in something that you either use or something you're more privy to. Like I said, I always use Procter & Gamble, ExxonMobil as an example, because I know that everybody watching this right now use toilet paper. Everybody watching this right now, you know, brushes their teeth. They use bleach. They use Clorox wipes. This is what P&G, Procter & Gamble pretty much encompasses, right? So one, invest in what you know. Two, you know, do your research on some of these companies, right? I would also, you know, when I talk to people, I usually, you know, tell them about these companies because of how strong and solid they are. Like, I'm really not into pushing people in, or I wouldn't even say pushing people in, but, you know, trying to get people to invest in crappy stock where they can lose money. You know, I'm more of an educator, you know, so I want people to really grasp and understand the concept of investing. So with that being said, like companies like ExxonMobil and, you know, Johnson & Johnson and Microsoft, these are strong companies that have been in the industry for 10 plus years. You know, they're safe, not guaranteed, for disclosure. Nothing's guaranteed. But from a fundamental perspective, these funds, these companies have weathered the storm for decades. And when I say weather the storm, it goes back to that economic cycle we're referring to, right? They have strong financial backing. You know, they're able to pay all of their debts, and they're able to reinvest in themselves, and pay dividends to their shareholders as well. So somebody who's just want to kind of get their feet wet a little bit, I would say safety first, you know. And when I think of safety, I think of blue chip, you know. So yeah, that would be, you know, like my starting point. for someone who would come to me and say, hey man, what do you think? What do you think I should get in? What's out there? I would always think safety first, because with that, with that safety, you kind of get you'll be more comfortable with what you're investing in, and you'll want to learn more about it. You're not too worried about, oh man, am I going to lose money or anything? Because you understand that the company has a very strong financial backing behind it, so that will allow you to allocate more time into learning, what are the ins and outs of the company. And then once you kind of increase your investment acumen, then you can start, getting into a little bit more sophisticated securities like, ETFs or, options and stuff like that. But for somebody who's just starting out, play it safe, do your due diligence, invest in what you know.
Absolutely. Absolutely. I mean, well, brother, thank you so much again, Mr. Moseley, for coming out. For coming on the platform. Family, I see family has joined in. More
Absolutely.
Family members have joined us. Family, do you have any questions for Mr. Moseley before he heads out? If you have a question at this time, please post your question or even a comment in the chat. But I see they showed you a lot of love, Mr. Moseley. I see that we have. Oh yeah, they love you. They say you did an awesome job. They say you were very knowledgeable. They learned a lot of information. They said you disseminated a lot of good information. So thank you so much. So family, if you have a question, post your question in the chat at this time, and I will ask your question live on air. But if awesome. If you don't have any questions, we're going to go ahead and head on out.
All right. Well, thank you. I really appreciate that, and I'd love to come back.
Absolutely. I want to bring Mr. Harris on to talk about real estate. I believe he owns his own real estate company.
Absolutely.
And he's doing very well. And so I want to bring him on. I wanted to bring him on, and also Mr. Daryl Kemp on. Daryl Kemp is another person who owns a real estate company here in Baltimore, and he's doing very well. And if folks, if you're familiar, if you want to Google him, you can Google him, Daryl Kemp and Associates. I think they're in the process of acquiring the old Target over there by Mondawmin Mall. That's nice. A multi-million-dollar deal that they're working on. Okay, so we do have a question from Brother Tiwolo. He says, what do you think of family investment groups and starting kids off young?
Beautiful. I love it. I think that's where it should start. I think that, you mentioned something earlier, how, in your household, your family didn't have these discussions, and when I got into like corporate America, these were the discussions they were having at the dinner table with their kids, investing, one-on-one at the very basis. It wasn't until I was like 18 and 19, or when I got to Morgan, where I was really exposed, to the investment world. And from there, I just became, very intrigued. But to answer your question, yes, I think it's imperative that we teach our youth the fundamentals of this stuff, and even practice with them, give them a piggy bank or something like that, or like little activities and stuff like that, or, open up accounts for them, and, you do like a joint tenants or some sort of account where they're on it, just kind of, teach them the ropes. And this is important. We talk about financial literacy.
That's right.
And it's imperative that we teach our youth this stuff so that they can be ahead of the curve,
Absolutely. I made sure that well, he's 10 now, but my 10-year-old, we opened up an account for him when he was about 6 or 7. Mm-hmm. And we put $25 a month in his bank account, and I think this is since he was 7 years old. And we also purchased some shares for him. So like you said, we gotta start him off, like you said, young, young. Yeah, young. Yeah. And then, you can add your child, to a credit card. And so you could be building your child's credit score. Now I'm not saying add them to a card and you don't pay on time. If you add your child's name to the credit card, pay the credit card on time.
Pay the credit card on time.
Absolutely. But you can add your child's name to a credit card to build his or her credit. You can do that also.
Yep. Absolutely. Yeah, the family, the investment groups are really good. I remember when I was at Morgan, and we had an investment group as well. I was actually a part of the finance club, you know, and I felt that that was very, very informative, and it really like sparked my interest even more, because you all are like-minded individuals. You're learning with each other, and you're actually in the midst of seeing things materialize, how it actually work, you know. And I think for me, seeing how it actually worked and saw that it was working is what kind of like drove me even more deeper into the investment space. It's like someone in the gym, you know, you go to the gym for a week, you don't see any results, and you go to the gym the next week and you see that one ab, you're like, oh man, I think I can keep this going. Let me hit it another week, you know, and see if I could get my full six pack. But yeah, definitely the investment groups are good. You have to have discipline, have to have order, you know, have to have be like-minded individuals, because it definitely takes a certain level of discipline and commitment. Investment definitely takes commitment. Absolutely.
Absolutely. And Brother Tawolo asks, he said, do you recommend platforms like Robinhood? I hope that you do, because I have the Robinhood app on my phone. Yeah. But he says, do you recommend platforms like Robinhood, or should we go with a more established brokerage companies?
Well, I think Robinhood is a really good platform to use, simply because it's really turnkey. Turnkey meaning that it allows you to, you know, do your research. It's not so overly complex. You know, it's a good starting point, I believe. I actually have a Robinhood account as well, you know, full disclosure. So I have a Robinhood account as well. And they also have an option where you could reinvest your dividends as well. So that's pretty good. Now, there are some other good platforms out there as well. I would encourage individuals to be mindful of fees that are associated with some of those brokerage platforms. And some brokerage platforms offer more services than others, meaning that some platforms may have a more robust investment options for individuals, and some may not. Like, I believe Robinhood is only limited to certain trades and certain options, where a TD Ameritrade may give you the option to open up retirement accounts and stuff like that, and ETFs, and, you know, margins accounts and stuff like that. So depending on what you're looking for, yeah, Robinhood is definitely a pretty good platform.
All right. And so Brother Cohen Davis asked, what is the importance of compound interest?
Compound interest is very, very important. I mean, compound interest is pretty much the essence of money growth, right? So we talk about dividends, we talked about stock splits, we talked about, you know, just mere fund performance in itself, right? So when you have all of those combined into one, that compounds on the principle of the money that you have, which essence makes your money grow. So that's very important. And it goes back to like the dividend reinvestment scenario, or scenario that I broke down. You know, the company pays you money, you don't cash it out, you put it back in the company, you know, you put it back into your portfolio. Hence, it makes it grow, and you want to keep doing that. So compound interest is very, very crucial part in money growth, wealth growth, and sustainability.
Okay. Beautiful, connected. Oh Lord, when you start talking about financial literacy to Black folks, the internet started acting up.
You start shaking the camera.
The internet started messing up. You talking about financial literacy? What? Economically stable Black families? No. We must keep them as a consumer class. What are you talking about here, Dr. Maat? But anyway, someone asked, Brother Rock City, New York asks, he said, what do you feel about Susu investments? So are you familiar with Susu's, Mr. Moseley?
So it's funny because I've gotten a number of calls last week from people who reached out to me about this Susu, I guess, platform, if you will. My only thing is, I often ask people, what is the service or product that's being sold with Susu, right? That's the question I first ask. And people typically say, well, there is no product or service. And I'm like, okay, then where's the money going? Who's the transfer agent? Who's governing the money? Who's overseeing it? Because I've seen platforms like that before, and I'm not knocking anyone who goes into those structures, but I would strongly suggest that people really understand or do their due diligence on it first before they pour their money into something like that. Because no one is governing it. One thing I can say about the stock market is that you have the SEC, the Security Exchange Commission, pretty much the Wall Street police who's governing, activity. I don't think the SEC or there's a governing body over Susu. I don't know if I'm pronunciating it correctly or not.
No, you are.
Yeah, I don't know if that is if they have a governing body over that. So me personally, I wouldn't invest my money in it because I'm not seeing any exchange of goods or services, meaning I don't see a commerce component there. I don't see any exchange being done there. It's just filtering money. So I'm like I said, I'm a very conservative investor guy, so I'm very cautious of stuff like that.
No, absolutely. I know that in Dr. Amos Wilson's book Blueprint for Black Power, he talked about using susus or tontines as a means of creating and establishing business. So yeah. I'm with you, Mr. Moseley. Like, what's the end game? Are we just passing around a pot of money, or you know what I mean? Like, what's the end game? So we all put our money in this pot. And so each month this pot is awarded to a person, but what's the end game? And I'm with you. Who's regulating this thing, and how can we hold all parties accountable, for their portion? So I'm with you. But I do want to ask you another question. Mr. Calvin Haynes asks, is there a rule of 70? He says, is there a rule of 70? Is the rule of 72 a real formula?
Yes, the rule of 72 is a real formula. Basically, it's a useful formula that is popularly used in estimating the number of years required to double investment of money, giving an annual rate. So it's in other words, people use that to say, okay, how long is it going to take me to double my money? So yeah, it's definitely a formula that's been used and still is being used, widely across, many spectrums, if you will.
Okay. All right. Thank you for that. All right. So family, do we have any more questions, family, before we head on out? Any more questions? And I'll give you a second to type your questions in the comment section. But family, look, tomorrow, join me at 8:00 p.m. I'm going to have Baba Walima Baruti on at 8 p.m. to talk about African liberation and African nation building. And anybody know Baba Baruti, he goes in. And so I'm excited. I feel like a kid waiting on Christmas or Kwanzaa, to have this discussion with Baba. This is going to actually be my first exchange with him. He and I have been talking via Facebook Messenger for years, but like we've never actually had a dialogue online or offline with each other. So it'll be interesting. With a lot of the other master teachers that I brought on, I've already had like some rapport. I had a good rapport with them, and we've talked online and offline. But this is the first time that I've ever, talked to him. On the phone. Yes, this is the first time. So I'm really excited about talking to him. I had a beautiful discourse with his wife, Mama Ya Baruti. So family, go into the archives and check out that interview. We talked about African-centered education and how it's the vehicle to empower the African world. And so check that out. That's his wife, Mama Ya Baruti. And so I'm going to have her husband on tomorrow at 8:00 p.m. So family, be sure to join us. But any other questions, family? Any other questions?
So Dr. Ma, I do want to go back to the rule of 72. I just want to put some more clarity on that. So the actual formula is like this, right? So let's say you have an annual return of 8%, right? Let's say you have an annual return of 8%. What you will do is you would say 72 divided by that 8%, and that will give you 9 years. So essentially 9 years you would double your money. So that's just going back to that question about the rule of 72.
Okay. And Brother Cohen Davis asks, he said, how does one avoid paying heavy taxes or commissions on day trading?
That's a good question. On day trading, I think, well, one, as far as commission, you would have to understand what the commission structure is for whatever platform you're using. Remember, whatever different discount brokers they use, they pay different commission fees. So that's one, just kind of understanding what their commission is. Two, as far as taxes, I don't think that there is. I think there's a certain threshold on short-term capital gains tax. Threshold meaning how much you're actually making. So I mean, if your short-term capital gains is, I think, over like 50,000 or something like that, then that's when Uncle Sam is going to start knocking on your door, you know. But I think if you're under that threshold, I don't think that there's no like significant worry about that, you know. But I would also advise you to, you know, speak to like a tax consultant or, you know, a tax advisor in that space of from a tax perspective.
All right, beautiful, beautiful. All right, so Mr. Moseley, we're going to wrap on up. I know I kept you 15 minutes past what I promised. I mean, but these were really good questions. You know, like these were really good questions, and so, you know, I thank the family for asking them, because I even learned a great deal in you answering these questions. And so, again, thank you so much, Mr. Moseley, for coming on the platform. I do appreciate your time, and you have to come back, Mr. Moseley.
Yes,
we got to bring you back, because I think that we just kind of we just scratched the surface a little bit. Yeah. But definitely, I would definitely like for you to come back.
Absolutely. Peace and blessings. Thank you all. I appreciate it.
Yes.